Welcome to Within the Frame, where we bring the most pressing issues across the globe into focus. I'm Kim Mok-yeon. The Bank of Korea has made its first interest rate hike in 3.5 years, ending a long period of policy easing and signaling a renewed focus on inflation. But that's only part of the story. Financial markets have been whipsawed by sharp swings over the past 2 days, while next year's minimum wage has also been finalized, raising fresh questions for businesses and consumers as well. So how should we read into these developments, and what do they tell us about the road ahead for South Korea's economy? For answers to this, we connect to Shim Myungkyu, Associate Professor of Economics at Yonsei University. A big welcome, Professor.
Thank you for having me.
And also joining us is Kwak Jun-hee, Assistant Professor of Economics at Sogang University. Good to see you, Professor.
Yeah, good to see you again.
So let's start a discussion right away. First with Professor Shim. Of course, with the BOK's rate hike, we're hearing it's 0.25 percentage points. What factors do you think drove this decision?
There seem to be two main factors behind the scene. The first factor is inflation. And today's decision suggests that the BOK has become more concerned about inflation than it was just a few months ago. Particularly, if you look at the data, inflation rate rose from 2.6% in April to 3.2% in June, while core inflation also remained above the BOK's target. Higher global energy prices, a weaker Korean won, and improving domestic demand have all increased the risk that inflation could remain above the BOK's 2% target for longer than previously expected. And the second factor is the timing. Monetary policy affects the economy with a considerable lag, so the BOK generally needs to respond to where inflation is expected to go, rather than simply where it is today. In that sense, today's decision can be interpreted as a preventive move aimed at keeping inflation expectations anchored at the current level. And also at the same time, today's decision also tells us that the BOK has become more confident about the economy's ability to withstand slightly tighter monetary policy. If policymakers believe that growth was still very fragile, they would probably have preferred to keep the rate unchanged. So I think today's message is not that the economy is overheating, but rather that the balance of the risk has shifted. A few months ago, the main concern was supporting economic growth. But today, the greater concern is preventing inflation from becoming more persistent.
Right, indeed. So inflation, it appears to have taken priority once again. Now, if you build on this, Professor Shim, do you think today's move would mark the beginning of a broader tightening cycle? And how many more rate hikes do you expect for this year?
I think that today's decision is more likely to mark the beginning of a broader tightening cycle than just one-off move. Inflation has moved well above the BOK's target, and the pressure from energy prices and the exchange rate are unlikely to disappear immediately. However, I would not expect a very aggressive or uninterrupted series of rate hikes. The BOK still has to consider household debt, borrowing cost, and the risk that higher rate could weaken domestic demand as well. So the most likely approach is probably to raise rates gradually, pause when necessary, and reassessing data to make another move. So my baseline expectation is somewhat similar to what market expects. There would be one additional rate increase this year, which should bring the policy rate to around 3%. But the second additional hike cannot be ruled out if inflation remains persistent, energy prices rise further. If inflation remains persistent, or if the Korean won weakens further, the rate could possibly reach around 3.25% in early next year. But I would say that 3.25% as an upside scenario rather than a certainty. If oil prices stabilize, the won strengthens again, or if domestic growth slows more sharply than we expect at this point, the BOK may stop at the current rate because of the concern that it has, which I commented earlier.
Right, but despite the inflationary pressure, Professor Kwak, many households are already apparently struggling with high borrowing costs. Do you think today's rate hike was unavoidable despite the added burden on borrowers?
Yeah, I think so. And to explain this, and I know that's hard to hear, but the Bank of Korea is caught between two bad choices. On one side, families with a lot of debt are in real pain. And remember, this is not just about home loans anymore. A lot of people also borrow the money to buy stocks these days, as you know. So for families that are in debt on both their home and their portfolio, a rate hike might be a serious shock. I don't take that lightly, but look at the other side. As Professor Shim already have mentioned, consumer prices are still rising fast, and the economy has been growing faster than we thought. So when things are overheating like that, raising rates are, uh, it's just not okay, but it's the right thing to do. Because if inflation runs loose and people stop trusting the central bank, that's a much deeper hole and it hurts those same families even more. So the answer is not to freeze rates and hope, is to raise the interest rate right now, but also give targeted help to the borrowers who need it most.
So it sounds like policymakers had quite little room to maneuver at the situation. But even so, these higher interest rates are expected to weigh on borrowing and investment as well. Professor Shim, how much of a risk do you think the latest move poses to the entire growth rate of South Korea's economy for this year?
I believe today's rate hike will have some negative impact on economic growth, as usual macro theory suggests, and Professor Kwak has already mentioned. But I would not overstate the effect. Higher interest rate will naturally discourage borrowing and investment. They also increase debt serving costs for households and small businesses, which could weigh on consumption and business activity over time. However, monetary policy works with a lag, as I commented earlier, and today's increase is kind of relatively moderate. More importantly, the BOK appears to believe that allowing inflation to remain elevated would pose an even greater risk to sustainable growth in the long run. And also is widely believed in the macroeconomics profession that greater inflation puts a lot of social the welfare in the economy. So we should also remember that Korea still has important sources of resilience. Semiconductor exports remain relatively strong until now, and if global demand continues to recover, exports can help offset some of the weakness in domestic demand due to higher interest rate. So I think today's rate hike may modestly slow economic growth this year, but it is unlikely to change the overall growth outlook dramatically, given that Korea is really a small open economy. In fact, maintaining price stability today can actually support more stable and sustainable growth in the future. Or I can say that today's rate hike should be viewed as the cost of maintaining long-term macroeconomic stability rather than simply a drag on economic growth.
Right, definitely. So it has its pros and cons. But speaking of semiconductors, you've mentioned it a while ago. Let's turn to the markets now. Korean stocks have plunged again, and both the Kospi and Kosdaq triggered sell-side circuit breakers. Professor Kwak, what is driving such extreme volatility these days?
Right. So these days there is, a lot of volatility. So it's very difficult to identify a single factor that explained this phenomenon these days. But I think today is really a chip story. So Samsung and SK Hynix fell hard right from the open and that pulled the whole market down. So those two names are so big that when they drop, the index drops with them. So why did they fall? People are starting to doubt whether the huge spending on AI infrastructure driven by hyperscaler can keep going. That worry has been around for a while, but overnight it became real again. So Morgan Stanley put out a report saying that higher electricity costs and environmental pressure are causing more and more data center projects to be canceled or delayed. Once that's on paper, the what if AI spending slows down fear suddenly feels concrete and confidence fell apart. So you saw it in New York first, Micron down 8%, Intel down almost 5%, and so on. So our market opened nervous and just followed it down. So the main point is that today is not really about Korea, I think, but it's the whole world rethinking the AI trade. And because we lean so heavily on chips, we feel it more than almost anyone.
Right, definitely. So semiconductor shares have once again led this decline. Then let us also hear about Professor Shim's opinion. Do you think investors have become more concerned about the fundamentals?
So if we look at the stock market, we can think of two ways to interpret the collapse in the stock market. So today, it is the reflection of the technical correction, or it is a growing concerns about the fundamentals, as you just pointed out. It seems that the part of the decline is clearly a reversal of yesterday's unusually strong rebound, which we now see every day, every single day. Samsung Electronics and SK Hynix rose very sharply in a single session, so some profit taking and position adjustment were inevitable. However, I don't think this is purely a technical correction. Investors are also becoming more and more cautious about the semiconductor outlook, as Professor Kwak just mentioned. The key question is no longer whether demand for AI will continue to grow. It is whether the enormous investment in AI infrastructure will generate profits quickly enough to justify the current valuations of the stock market related to AI infrastructure. There are also concerns about whether memory chip prices can continue rising at the same pace in the second half of this year. If supply expands or global technology companies become more cautious about investment earnings expectation for Korean chip makers could be revised downward further. That said, I would not interpret today's decline as evidence that semiconductor fundamentals have suddenly collapsed. Demand for high bandwidth memory remains strong, and both Samsung Electronics and SK Hynix continue to benefit from the investment cycle. So my view is that today's move or the recent move is more than a single correction, but it is not yet a fundamental breakdown. The market is reassessing very optimistic expectations, and that process is likely to produce continued volatility until upcoming earnings and investment guidance provide clear evidence.
We'll have to wait for those results. But if you look at the investors' movements, foreign and institutional investors are selling heavy, while retail investors are apparently buying the dip. Professor Kwak, what does that divide tell us about how different investors see the market right now?
Yeah, so first of all, I want to point out that there are many new investors participating in the market. So maybe many of them are novice investors. And to me, the big thing this shows is how differently these groups deal with emotion. So foreign and institutional investors, usually they follow rules and models. When the warning signs flash, they sell and move on. On the other hand, individual investors, including novice, are much more prone to emotional bias or psychological bias. And the biggest one here is, I'll say, loss aversion. It means the pain of taking a loss feels far worse than the joy of a gain. So what do? Instead of cutting a losing stock, they hold on and hope. and then they average down. So they buy more as it falls to lower their cost. It feels smart in the moment, but in a market that foreign investors are still pushing lower, averaging down often just means putting more money into a falling stock and the losses pile up. That's why I would be careful about reading all this retail buying as a sign we have hit bottom. It's less a confident bet on value and more a refusal to accept a loss. And the honest read stays the same until the foreign selling runs out. Retail buyers alone probably cannot steady the market.
So investors are seeing this market very differently right now. Now, if we turn to the labor market now, next year's minimum wage has been set at 10,701, which is up 3.7%. Professor Shim, do you think policymakers struck the right balance between protecting workers and supporting small businesses as well?
Yeah, I think so. I think this decision reflects a reasonable compromise under difficult economic circumstances. On the one hand, workers have faced rising living costs over the past few years because of the high inflation rate. So some increase in the minimum wage is really understandable. Higher wages can help protect the purchasing power of low-income workers and support household consumption. On the other hand, many small businesses are still dealing with higher borrowing costs, weaker consumer spending, and rising operating expenses. Many of them are already operating with very thin profit margins, so even a moderate increase in labor costs can have a meaningful impact on their viability. This is one reason why the government has recently expanded financial support program for small businesses facing higher interest rates. So I think policymakers were trying to balance these two objectives. The increase is large enough to provide some income support for low-income workers, but not so large that it would dramatically increase the labor cost pressures for employers, especially the small business owners. Of course, the impact will differ across firms and sectors. Large firms generally have greater capacity to absorb higher labor costs, while small businesses in labor-intensive sectors such as restaurants and retail stores are likely to face greater challenges.
Then what about Professor Kwak? If we follow up on that, what kind of impact do you expect this higher minimum wage to have on inflation, consumer spending, and employment next year?
So the short answer is, first of all, the 3.7% is maybe not the large, so maybe effect might be moderate, I would say. But still, as Professor Shim mentioned, inflation might be high, a little bit higher because labor costs rises when minimum wage goes up, and those effects will be concentrated on small businesses, I think. And then the effect on consumer spending is, I would say, ambiguous, because there is one good thing that if minimum wage goes up, then it means usually income of low-income households is likely to increase, and usually they spend a large share of their income into their spending. So maybe we say the marginal propensity to consume of those low-income households is usually larger than others. Then maybe if those effects might be also boosting aggregate demand. But on the other hand, there is a negative effect from rising labor costs. Then maybe the small business owners, they might lay off some of their workers. Then it means employment might decrease slightly. Then that has negative impact on the aggregate demand again. So I would say effects are ambiguous in general.
So we'll have to see how these effects play out in the months ahead. Now, that will be where we will leave our discussion tonight. Thank you so much for your insights, Professor Kwak.
Thank you.
And of course, Professor Shim, we really appreciate it.
Thank you.
And that's where we'll leave our discussion tonight. Welcome to, that'll be all for us from Within the Frame, excuse me. Be sure to tune in again next time as we continue to explore the stories that matter. Until then, stay informed and engaged.